Good morning, good afternoon, good evening, yWhales, wherever in the world you are today. So it's April. Q1 is over. I think we'll hopefully not look back and say we wish we could do that one again. But it's been a really turmoil start to the year, and the biggest bump that we've had is Bitcoin, shockingly, is back up to about 28,000, doing very well. The rest of the market, I don't think, is as healthy. And when I say the rest of the market, I mean the traditional markets. There's a lot of turmoil. We've had so many bank, implosions. We've had so many regulations. Gary Gensler is now like tweeting like crazy, as if anyone cares. And really kind of there's been this just direct attack on the asset class. But shockingly, it's held very strong, and we're still sitting right around that $950 billion market cap, which is very promising. However, the concepts that we keep running into are these regulated assets? Should they be regulated assets? And really, what is cryptocurrencies, and how should consumers, gain adoption to those? There's a lot of people that have very different feelings on the technology is enough to regulate them. But then there's others that believe that going beyond just the magic, blockchain pixie dust side of things is that real world assets can live on chain. I'm one of these believers in that, and that real world assets are actually the cryptocurrencies of the future. Because you're actually trading objects or cryptocurrencies or tokens that have linked to real world value, thereby establishing base level and really getting rid of a lot of the volatility. That being said, I'm very lucky to have an expert with me today, Carlos from Securitize, and you've been doing this for a while, correct?
Yeah. Thanks, Jay, for the invite to the podcast. It's my pleasure to be here. We started very early with this whole idea about, bringing real world assets on chain, back in 2017. At that time, it was not called real world assets. I think the crypto people have an ability to, retag things in a different way. But the whole concept was the same, right? Like, I still believe that the main use case for blockchain is as kind of like new rails for, financial services and capital markets. And what capital markets do, they basically, give access and trade and securitize, if you want, real world assets to be able to trade them and allow people to invest, etc. So that was the original concept, and I still believe so. Obviously, the industry has gone in a completely different direction for a long time, but I'm pretty happy that even though with a different name, that this team is coming back, because that I really believe that's the productive use case for blockchain, and not trading with imaginary internet money. So
magic meme coins. But real quick, Carlos, let's take a second and understand kind of where you came from, because I think it's really important to understand, the history you have, and what got you here today.
Well, I don't have a background in financial services or regulation, even though that's what I do 90% of my time now. My background is in technology. I have a PhD in computer science, and I've always been working in companies building products and trying to produce innovation to solve problems, right? So I started early on in my career at a startup. I was at the time in Japan. I studied the Tokenized of technology, and that was when the .com was kind of like booming. And the problem we were trying to solve back then was actually how to bring images to the internet, like high quality, high resolution images, which now obviously is not a problem because bandwidth is very big, but back then was a big problem. So we did that for different types of assets, whether there was art, like fine art, and digitize it and put it on chain in a secure way, or was, satellite imagery, which today is very widely accessible, things like Google Maps, but back then was not like that, etc. And how to manage them efficiently, right? So I've always been with this, that was called digital assets back then, and now the term means something different, but it was like about, bringing those digital assets that were imagery, online and allow people to basically consume them, right? That's how I started with my career. I did that for a few years, went through the ups and downs of the .com period, which was an interesting thing. So learned a lot. It was my first position as a CEO. We did acquisitions and, buy companies. Then I had to downsize when things were not working well. So it's not my first winter in an industry. And then I kind of switched completely industries. I was recruited by a telecommunications company in Spain called Telefónica, which is one of the largest ones. They have properties across Europe and Latin America. And the theme at the time was the same thing, like how do you bring services beyond connectivity, right? Telcos, for the most part, what they were providing was, bandwidth and connectivity, whether fixed or mobile or voice services and messaging. And then that's when kind of like the new 3G and things like that was started to take off. And right after I joined this company, the iPhone launched, and I think that was if you look at the different revolutions we had in the history of tech, mobile was one of the big ones, right? Because suddenly you had a mini computer in your hand where you could actually do a lot of stuff that you could not do it, and it also but it actually gave a computer to people that didn't use a computer, which is one of the interesting things, right? So it really expanded the consumption of online services in a dramatic way. And the fact that you could also have things like a camera and a GPS and stuff like that completely disrupted many industries. I do remember when I lived in Asia at the beginning, I used to travel a lot, and I used to carry my book guides and maps and stuff like that. But those things completely disappear, right? So it's very revolutionary.
You had to print your map quest before you went on the drive, because there's no way to do it when you're on the road.
Correct, exactly. There was no way to access those things online. By the way, I did work at that company that I mentioned at the beginning in the MapQuest project about bringing those images online, which is the predecessor of Google Maps, which was not very efficient at that time because of connectivity. But I was pretty fond of that service. And as you said, you couldn't actually carry it with you, right? So I think that it changed so many industries in many different ways. But the telecommunications industry, which is what I was working for, never managed to basically capture any value from that beyond that they obviously increase their core services, right? So after a few years doing that, I was kind of bored of telecommunications industry. I went through a couple of different telcos and just thought that nothing exciting was happening there. And I kind of stumbled upon blockchain. And how I discovered blockchain was through the ICO boom when it started in 2016. And I was kind of fascinated as somebody that has been in tech for many years, and I actually had done a lot of, early stage investments as an angel investor, invested in some funds, etc. I was fascinated by the fact that, people can just issue a token that you could purchase it. It gives you some sort of, upside or participation in the underlying project, which was the main reason why people invested, realistically speaking. But at the same time, then you had liquidity, right? Because those tokens got listed afterwards, so you could just trade them, etc. So if you think about venture investment, it's actually the opposite, right? First, it's very difficult to invest. It's not something that you can just go and do and throw $1,000 at it. And second, those venture investments are very liquid, right? Which makes it also not very convenient for most people because individual investors have different liquidity needs than institutionals, right? So you don't know what's going to happen. One day you change job and you have to go to a new city, or you have kids and then you have more cost, or you get divorced and you lose 50% of your things. And, at that point in time, if you only have illiquid assets, it's problematic, right? Yep. So I was fascinated about that. And at the time, there were people talking about how this could be an advantage to be able to deal with, illiquid assets like, let's say, venture capital, right? So together with a friend, we had this idea, why don't we do an ICO for a VC? Because it makes all the sense in the world, right? You give access to people to an asset class that, has very good returns, but it's very inaccessible. And the asset class is very liquid, so you could potentially trade this. So now the minor detail that we didn't know at that time is that these things are securities. So we talked to, different lawyers. And of course, that was 2016. So people were still trying to figure things out in the crypto industry. And some people had the view, well, if you can make your token a utility token, then, you don't need to follow any regulations because it's not a regulated asset. Some others told us, you guys are crazy. If this is a pooling money to invest somewhere else and you return money at some time and there's an economic interest in the underlying asset through the token, that's a security. And even though that was not my expertise, by looking at both camps, I kind of got to the conclusion these are securities, and so be it. Like, from my naive view back then, people trade securities all the time. You could go to Robinhood and buy Apple shares. You can, invest in a VC fund. All those things happen, right? So there's regulations. People just follow them and nothing happens. So we conducted one of the first, was called back then a regulated ICO, which was an ICO that, the token actually was a security and represented a real world asset. In this case, was a venture capital firm. So we did it. It was successful for the time when it was done. It kind of got a little bit of traction in the industry. And then in July 2017, the SEC issued the first report about ICOs. It was called the DAO report. The DAO was like kind of the precursor of the ICOs, if you want. And it said very clearly, this is unregistered sales of securities. So you're selling securities, you're not registering them, you don't follow exemptions for registration. So these things are illegal. And then someone say, well, we're not going to prosecute anybody, backwards. You've done what you've done. There was no guidance. Fair enough. But moving forward, you guys please follow the rules, right? And then you will think that people who will follow the rules, that actually didn't happen. But we believe people were going to follow the rules. And in fact, few people did follow the rules and approach us and say, like, how do you guys have done this regulated ICO? That's when the term security token came into market as opposed to utility tokens. And it felt like that's a big asset class that is potentially much productive and much bigger than utility tokens because, securities, it's a huge, multi-trillion or dozens of trillions of dollars in size, right? So if you can actually make them more efficient, put them on the blockchain, democratize access, trade them, etc., that's a huge opportunity, right? So we started the company with that premise. That blockchain was basically, more efficient rails for dealing with securities than what traditional capital markets have. So two things happen. So first, crypto people continue playing regulatory arbitrage, continue doing ICOs, and when they exhausted the ICO path, then they come up with a governance token as another way to bypass securities regulations, and then NFTs and you name it, right? And I unfortunately think that will continue happening. Crypto people have a very creative and coming up with things to bypass regulations. So, but we took the path of, no, these are regulated assets, so let's figure out how we manage them on chain, right? Because I still think that there's a lot of inefficiencies if you look at how capital markets function today. So they're poorly digitized, etc. So what we didn't know was there's going to be this very long, regulatory journey in terms of ourselves getting the licenses and also kind of stumbling upon the issue that, blockchain does actually do things differently, right? Like, is a distributed ledger, is that like a legal ledger where you can actually represent securities? When you trade on chain, how do you settle them? How do you provide dividends? Can you use stable coins or not? Like there was all sort of, can you custody those securities? There's a lot of, issues that have come up over the years. And we basically started getting our licenses to be able to operate. So in June 2019, we were registered as a transfer agent with the SEC. Mm-hmm. Transfer agent is the regulated entity that precisely manages securities. So with the idea of doing it on chain. And then subsequently in 2021, we got a broker dealer and an ATS. So a broker dealer allows us to sell these tokens that represent securities, and an ATS is an alternative trading system. Is basically the license that allows you to trade them on secondary market. So you can create an order book, very similar to how you will trade public securities.
And that's US based.
That's a US, it's all under the SEC. So we went also the hardest path, if you want, from a jurisdiction perspective. But look, at the end of the day, if you figure out the US, we talk more about what people are doing with real assets these days. I see a lot of projects that they block the US because they don't want to do the hard work of like figuring out how to do it here. But the US is the largest financial market, right? So if this industry only works outside in Switzerland or in Malta or in Gibraltar, it's never going to be a big industry. I still believe that. So anyway, we took that path. It's been a long journey, but here we are. So
there you go. No, and I always love starting with about you, because to me, you were there for the birth of Web 1. And you've seen the kind of the evolution of, where Web 2, the mobile internet, the ability to kind of, write, more fluently up there. But a lot of those early Web 1, kind of lessons are now being, reiterated on Web 3, which are very different than Web 2. So I always say Web 3 is kind of like the rebirth of everything, because we kind of have to start over and go, we kind of missed a key section of this, which is actual ownership, the ability to actually have, this ledger that's on there. And it's desperately needed for a true online experience, because otherwise you're just, it goes into a black hole. And we've seen what this happens. We haven't fixed to date any of the banking issues with any amount of blockchain technology. And so I really do agree with something you said, which is that the blockchain degens, which I know and love, they always try to fix regulation problems through technology. And the challenge is you can only have so many loopholes when you're talking about a regulated asset class that is being governed by people that are trying to protect clients and consumers' interests. And to be perfectly clear, the raw Web3, do whatever you want is not a safe place to trade. Whether you're on a centralized exchange or decentralized exchange, it's a very, kind of volatile and dangerous asset class. That being said, when we start talking about security tokens, we start talking about digitized assets, real world assets. I'm sure you thought in 2017, this is right around the corner. Like we're, going to have any day it's going to hit.
Here we are around the corner.
Yeah. Here we are 6 years later. We still don't have a name for what this is. That's how early, we truly are. But, the question I have for you before we kind of jump into exactly what Securitize does is, what are some of the hurdles that you guys have had to overcome to help connect regulation with the technology to really bring it into the fact where you can even have intelligent conversations with regulators?
So look, when we started talking to regulators in 2019 and today, I would say that the situation is fairly different. At least today, you do get more knowledgeable people that have thought about the problems, except not necessarily all of them, but, a lot of people, both, we've talked to recently with some staff, some congressmen that are working in regulation and people at FINRA, the SEC. There's a lot of people that are pretty knowledgeable. I think that there's still a bit of a confusion of what the SEC now refers to crypto securities, which they are basically saying XRP is a security versus a security, something that has been issued with the intent of being a security, which is managed completely different on-chain. Yeah. I think that's a sticking point. And then there's still also a lot of issues with the tech itself, right? Like, is it really decentralized? Is it, can you, if you have a fork or if you have a 51% attack, what happens with your ledger? Because fundamentally, one of the things I think is that I'm not in the camp of that blockchain is good for censorship resistance and, destroy the government and all that stuff. I think that fundamentally, as you said, a blockchain solves the problem of being able to track ownership in a reliable way, right? And if you think about it, that doesn't really exist anywhere. Like if if I own, shares of Apple, believe it or not, I don't have a simple way to prove that I actually own shares of Apple. There's not a ledger that I can, prove people, here are my shares and this is what I own. So, because they are not there, they're at the broker dealer, then the broker dealer doesn't really own them, they're at the DCC and blah, blah, blah. And for private markets, it's even worse, right? Like sometimes it's just paper-based and people have signed subscription agreement. The ledgers that they use are things like Carta, which is unreliable because humans have input the data and anybody can change it. And, you might have got divorced and suddenly you don't own 50% of the shares, but that didn't get recorded anywhere. And because the person that got the 50% of the shares doesn't have to actually carry those shares with them, like let's say in the form of a token, for instance, then there is a lot of inconsistencies there. So at the fundamental level, I think that blockchain solves this problem of having this public, cryptographically secure, distributed ledger that you can rely to know who owns what, right? And as simple as that it is, that's actually a big thing. And then on top of that, you can represent on the same ledger things that represent securities with things that don't represent securities, like let's say a stable coin, which is a digital dollar, right? That solves the other problem, which is when you trade in capital markets, the ledger that tracks the securities movements versus the ledger that tracks the cash are disjointed. They're not in the same ledger, right? So this is why things don't settle immediately, and this is why certain things are complicated to do, because you need to make sure that if I sell you $10 of securities, you get the securities, I get my $10, right? And this on-chain is a very simple thing. It's an atomic swap between two tokens. One represents, let's say $10 through whatever USDC, and the other one represents $10 of a share that somebody like us has issued on behalf of an issuer, right? Yeah. So it solves fundamental problems that, could completely revolutionize how people, represent ownership and hold securities and trade them.
Yeah. So let's just dive right in, because I fully believe in the way you guys manage. I've loved Securitize. I've watched what you guys have done. I have not traded on the platform, but I kind of watch and really watch you guys' social media, because I am a technologist, but I'm also like a regulatory compliance nerd. And I look and go, there doesn't need to be one or the other. Both of these two are needed for us to hit the true market caps that we want. $3 trillion, that's nothing. That's like, congratulations. We've proved a concept that we can actually hold value value there, but the entire thing is built on a house of cards, and that's not what we want for the next version of the true global economic model. Now that being said, the quick number that I like to say is there's $9 trillion a day in trades that occur around the world. So $9 trillion moves every single day in the most inefficient and clunky ways possible. So that being said, go ahead and describe, really what Securitize does and kind of where you guys are at in the market today.
So in capital markets, let's start breaking them in two different parts. One is public markets, which is this $9 trillion a day that they trade. And they have their own set of inefficiencies, but they have a very, if you want, inefficient but robust infrastructure that has been created to make people trade, right? And there's so many things I could think of that you could improve there, but for the most part, it works, right? You can open a Robinhood account and go and buy Apple shares, and within a second you have them on your account. They're not really there, but it looks like you bought them, and so when they pay a dividend, you don't get it immediately. It takes you like a few weeks, but fine, you get it. And so I think that that public markets are regulated in a different way than private markets. So the infrastructure is there for a reason. So, which I think it will be very complicated to displace. Now, private markets, which are huge as well, and actually they've been performing better than public markets and growing faster in terms of new amount of capital being raised in private markets in the last, 10 years or so. They're also like multi-trillion dollars. They suffer of different problems, right? They suffer from the basic lack of infrastructure. Nothing is digitized there. Everything is paper-based or at most, simple centralized databases or Excel in some cases. They are very inaccessible. They're extremely liquid. It's difficult to borrow against them, etc. So we early on decided to focus on that part of the market because we felt that it's easier to tackle a problem when you don't have to displace existing infrastructure. Because, displacing infrastructure is a complicated problem, especially when you're, as you said, that infrastructure trades $9 trillion, right? So it's not like you're not displacing something small. But private markets don't have infrastructure. And I think that's the great thing, right? Like we could start from scratch and envision how private markets will be digitized on chain and how you bring all these assets, whether it's private equity, VC, credit, real estate, etc., on chain to make them more accessible and make them more liquid and eventually borrow against those asset classes that are difficult to borrow against for the same thing, because you can't prove the provenance of the collateral and who owns what and how do you move it, etc. So.
Yeah, and give us a couple examples of private markets. So sometimes referred to as dark pools, correct? So these are, they can be traded amongst small groups or some very large groups, but these aren't traded on the traditional stock market, even though they are regulated securities, correct?
I mean, all securities are regulated.
It's true. I'm sorry.
So, some of them have to be registered. Some of them are exempt from registration. So people tend to think that the ones that you don't have to register are not regulated. They're still regulated. But when I refer to private markets, I don't refer to dark pools for trading. Those dark pools, for the most part, they still trade public securities, let's say Apple shares and stuff like that. Whatever, I'm referring to private assets, right? So, venture capital is a private asset. It's not registered, it's not publicly traded anywhere. Private equity, which is a huge asset class, is there as well. Credit, which is now becoming very popular in the crypto space because credit is, if you want, in some instances, is less regulated than securities. Real estate, etc. So those are the kind of also people refer them to as alternative assets, which is something that has been growing tremendously the last, 10 to 15 years. And all institutional investors, they do have an allocation into private markets and alternative assets because they know it's a good asset class that performs well and helps you diversify when there's volatility in public markets, having private assets, etc. But if you think about individual investors, most of the people have never invested on a VC or have never invested on a private equity firm, have never invested in a credit fund, etc. Again, because on one hand, they are very inaccessible and they're not, because they're not digitized, not suitable to a broad adoption, and they don't provide good fractional ownership of it. And the second is because they are illiquid, and the illiquidity obviously create a problem, as we discussed, with individual investors. So we focus on basically how we bring those assets on chain. The first thing we do is we have a tokenization platform that allows you to issue a token that represents a security which is backed by that private asset. When you talk about real world assets, I don't know if people realize that you're not bringing a building on chain, right? That the concept doesn't exist, and I don't know if it's feasible because of how building registration works. What you do is you basically securitize the building and issue a token that represents an underlying economic interest on a fraction of the building, right? And it's a traditional securitization process that finance has, used for decades, and that's actually why we want Securitize, right? Because we believe that that's the right way to bring real world assets on chain. So the first thing we do is this: we tokenize the asset. We have a license to issue those securities as a transfer agent. We'll do investor onboarding management, all the legal stuff that is required to issue the asset, register the wallets, issue the tokens in a compliant way, controlling how the token moves around. Like, these are securities, right? So if I sell you one security, maybe you cannot sell it right away, or if you sell it, you can't sell it to somebody in North Korea because it's not allowed to hold a US security. Yep. So those are the other things that are different than cryptocurrencies or
they're permissioned. They're not permissionless.
Once they are on chain, they are permissionless if you want, because they can move by themselves. But there's a set of rules that controls how they move, which are implemented through smart contracts. So it's a slightly different. It's a bit of a hybrid model if you want. But I believe also that the pure permissionless DeFi stuff will never work for real world assets, because you will break all sort of rules, right? So that's one thing. And then the other thing is we have a portal as a broker, and we've been providing this service to companies more than 250 over the years, and that's been our bread and butter so far. And then more recently, we launched a broker dealer where you can actually purchase some of those securities directly from us. We obviously been much more careful what we place there in terms of the securities, and then we also have a venue where you can actually trade them in secondary market once they've been issued. So that's kind of like the blend of this suite.
Yeah, and I love that. There's so many concepts, and again, for people that are listening that really want to understand exactly what Carlos is saying, when you put a building online, it's not, here's the title of it, everyone go figure it out. This isn't, there's not a DAO that's doing this. These are companies that have fiduciary responsibilities to own, run, and manage that building for most parts. They're selling some equity and shares in there into a way that you can invest in something that's physical, has known returns. Most of the commercial buildings, they're going to tell you what their cap rates are and what their, give you an idea what their rent rolls are. That's a great thing. I love commercial, real estate investing, except I hate the fact that there's no liquidity. That when I want to get rid of a building, I've got a couple buildings right now, either I got to sell the whole thing or I'm just stuck with it. And it takes months and months and months to move these things. So the idea of me taking 20-30% of the equity of this and putting it on chain through someone like Securitize, it's very attractive investment for not just for me, but for others that say, hey, I do want to get in on this.
And keep in mind, people might not have money to buy the entire building, right? So they just want to buy a fraction of the building because they still want to participate on the upside of owning a building, right? And the other good thing of fractionalization is that if you want to sell your building and your building is worth $10 million, you need to find somebody that first has $10 million and second wants that particular building, right? And agrees on the price. Well, if you break this $10 million in 10 million, let's say, tokens, every one of them representing $1 of economic interest in the underlying asset, then it's easier to find people that want to buy $1 or $10 or $1,000 and build out the fractional ownership rather than have to find one person that wants to buy the whole thing. Right? And that democratizes access to the asset class, which is the intent of what we're doing. So.
And the thing, and again, they still can be traded. So you can say, hey, I bought in and there was, 80% vacancy in this building and now there's less than 20% vacancy and I'm going to go ahead and sell now. Somebody else would like to go ahead and get the dividends or the returns or however they're going to manage it on chain. And I think that's always one of the most interesting things about, digitizing securities, is that you can actually have, so let's just say you want to raise $1 billion to build a building or to build a company or whatever the case is. That's a much more valid business model than we're going to put $1 billion collectively into a meme coin and it's going to go up because things go up. And so it's an entirely different way to look at cryptocurrencies once you understand that this exists.
I agree. And I also think that a lot of this tech that has been developed in the last few years for the non-regulated assets or maybe regulated assets that we're treating as non-regulated, I think this is still useful, right? So I'll just give you one particular example on something I like of DeFi. So DeFi has like two things, right? Automated market making and then borrowing and lending, right?
Mm-hmm.
So borrowing and lending is actually a good use case for for real world assets, right? Because sometimes, if you buy an asset and somebody wants to lend you against it, you need to prove that you own the asset, right? And that you still own it, that it's not encumbered by anything, that you haven't sold it, that you haven't got divorced and don't own 50% of it, that you haven't actually borrowed against it with somebody else, etc. And that thing that is very well solved, let's say, for houses and mortgages, because there's a whole system set up to do that. It just doesn't work for other asset classes, right? Like if you go and buy, a private equity fund from, one of the wirehouses, let's say Morgan Stanley, and you go to JP Morgan and tell them, oh, I want to borrow against this. First thing is they're going to tell you, how do I actually know you own the asset and you purchase it and things like that. So going back to what we were discussing about why blockchain is useful is because there is a irrevocable proof of ownership on the asset. And as far as you have it there, it's on your wallet, it's on chain, and it hasn't moved, means, you haven't lended, you haven't sold it, and it's still yours, right? So the basic premise of, tell me what you own so I can verify it and lend you against it is very simple to do. And then the second thing is, okay, now I lend you 30% loan to value against this asset. How do I make sure you don't get rid of the asset somewhere because it's the collateral, right? So again, moving into a smart contract, control it from there, etc., is a very elegant way of solving this. And then the third thing is, well, this loan fails to repay. How do I seize the asset, right? Like I need to take the collateral. It's on mine now because you didn't pay me the loan. So, and then I have to liquidate it, right? So again, the smart contracts and tokens solve this problem very elegantly. So this is an example of things that could be very productive for real world assets, but that today largely they are applied to all sort of, unregulated things that, as you mentioned, might be meme coins or, FTT tokens or whatever people come up with. So.
We don't talk about those FTT tokens anymore. So one of the things I want to point out is, right on your website, you guys have, your primary and your secondary market. So people can choose, where do they want to trade? Do they want to, be on the primary or secondary? And two, you have, great investments, like KKR is on here, Hamilton Lane. These are well-known names and brands that, could you call KKR? Of course you can. Hamilton Lane will be thrilled to take your call. But that's not where society is going. And that's kind of not where, the world is trending. And it's also much more complicated because either any one of those, they're going to want to sell you a much larger package than you most likely want. Even if you are an accredited investor, you want to be able to have choices and jump in and out. And the fact that you can have, KKR and Hamilton Lane, right here on your homepage that people can bounce in and out of, that's a dynamic difference and dynamic shift from the traditional broker model, which is I call my dude and I got to talk to my dude. And if I'm done with my dude, I got to end that relationship and go somewhere else. This is entirely putting everything on chain. It's a much more frictionless system. So I entirely believe in the concept of blockchain. It's a struggle to get the adoption and to get the education.
I mean, the adoption, I believe, will come. It's just a matter of time. And I think the fact that, the other side of crypto is getting regulated will push people towards regulated assets. And I think that, as you mentioned, you say, well, you can call KKR or Hamilton and they will take your phone call. I'm not sure about that. Like, I wouldn't know where to call KKR, right? And KKR themselves, they will probably don't deal with an individual investor that wants to invest $20,000 in their funds, right? That's the minimum investment actually we have for both KKR and Hamilton Lane. It's very low. So it's supposed to be very accessible, right? KKR cannot handle tickets of that size. They don't have a simple way to onboard an investor, KKR or Hamilton Lane or any of them. For that matter, they don't have a simple way to issue the securities in an efficient way, manage them, provide eventually liquidity, etc. So I think that's where this technology comes into play as a way to basically take those, really good assets and bring them to people in a very simple and automated way and digital way. So.
Yeah, I love that. So when you guys are looking to onboard, whether they're funds, whether they're assets or everything else, what's kind of the bread and butter, the main, criteria that you want, at this time, again, we're still in that early phase. We haven't hit global adoption yet, clearly, but what's the best, asset class you think to be tokenized right now?
So as I mentioned, we have two business, right? The B2B business where, we act as a a tokenization platform, as a manager of those securities on chain through smart contracts and etc. So that's the transfer agent business. From that business, we would basically work with anybody that is legit, right? So we don't care. It's a service, and the more the merrier. That drives revenue, etc. Now, when we put it in our broker dealer, as you said, you come at securitize.io, right? So it's our brand. People are buying from us, even though it's like a KKR fund, but it comes from us. And then there, we're trying to, for the time being, be very careful in how we build a business by trying to put very few assets, very high quality things that we think are from reputable brands that people will want to access that today are not accessible, etc. So that's kind of like the theme, and we've been trying to do it very carefully. I think, as I mentioned, alternative assets are a very interesting asset class that fits that description. So we have now 2 private equity funds. We're gonna soon put up there a credit fund, which credit these days is a very popular thing because you try to beat interest rates. So we're looking. The other one we're going to do soon is secondaries for private equity, which is people that purchase in the middle of the cycle, so they avoid the J curve that private equity fund has. And then we're looking also at some real estate projects, etc. So within the realm of real estate, of alternative assets, I think those are the categories that we're trying to put there. But as I mentioned, we're trying to go slowly, work with these large tier 1 asset managers that have a brand name that people will trust that the asset is a quality one, because it's also a new asset class that most people don't necessarily understand, right? So it's very hard to judge, which one is a good private equity fund or another one. But if someone tells you, well, KKR is the manager, then you probably are going to trust that their performance is going to be, more consistent than somebody you've never heard of. So.
Yeah. And that's, kind of the other side of this is right now, if you want to do research on fund to fund to fund to fund, it's a lot of work. You're going to wait for a trade, some sort of trade, trade metric or trade magazine to be able to put out some things, versus if all of this is trading on chain and you can see distributions, you can see liquidity, you can see growth and volume. That's very transparent. That's very easy for people to make a choice, and for the good managers, the good fund managers, to rise to the top, which I think is good for consumer adoption and protection, and for the ones that quite simply are full of hot air and aren't producing, that consumers have the ability to retract and take their money elsewhere to people that are being respectful of their time and money.
I have my own view about individual investors doing research. Look, nobody reads, for instance, when you invest on Tesla shares or on Apple shares on Robinhood, nobody reads their filings, right? No. People just think, oh, well, Apple is a good company. I believe long-term will be more valuable than it is today, etc. And if you look at crypto, it's even worse, right? Because there's nothing actually to research, because those companies are kind of like zero transparent in terms of what they do with the money or what is that they're bringing. It's just all based on perception and not facts. And I think FTX is a good example of that, a company that people bought the FTT token because the perception was FTX is a good company. It turned out to be a complete fraud. And then those tokens went down to zero, or Terra Luna before, same thing. There was no reason why those assets will be worth anything except perception that they should be worth something. Yep. So I think that the private markets is the same thing. Like, I don't expect that people are going to do due diligence on the private equity KKR fund. All the disclosures, of course, are there because these are legal sales of securities. You have to disclose all those things. But I think people are going to kind of like look at the high level information that we provide in terms of like what's the historical performance, which obviously does not necessarily reflect future one, but it's always there. Who is the manager? Where do they invest? This, in the case of private KKR, is healthcare, which is obviously a very interesting, potentially growing industry because of the need for digitization, adoption of new technologies, etc. I think that should probably be enough for you to allocate a part of your portfolio into that asset class to get exposure to it. The same way that you allocate something to public stocks or crypto or some other asset classes, right? I think that the portfolio construction that we mentioned, that what large institutional investors do, it doesn't trickle down to individual investors because of the lack of accessibility, right? So I always tell people, like, look, if you want to invest like the best, then you should have some of these assets on your portfolio, because that's what the pros do, right?
And those are going to outperform, well, not every day, but I mean, over the long term, a lot of the meme coins and a lot of the silly JPEGs, that people have thrown, tens of thousands, hundreds of thousands of dollars, millions of dollars into just based on FOMO. And listen.
I mean, look at yesterday. Yesterday, Elon Musk put the Dogecoin logo in Twitter, and it went up like 30% for no reason.
Yeah, there's no chaos or rhyme or reason to this. So, Carlos, one of the most amazing things about this is just the concept of eliminating these old paper and Excel and just these horrible metrics of bookkeeping that are so outdated compared to the new technology. And again, I'm not talking about Bitcoin. I'm not talking about Ethereum. I'm talking about the idea of the decentralized ledger and the immutability of blockchain, which has been proven to really showcase that it can't be broken. Humans do their own thing, and that's a whole different story that we can't fix today. But the idea of what you're trying to do of saying, I just want to do the same thing, but in a better system. How do you educate and onboard, with that?
This is a very important point because, if you look at where regulators are now, they're kind of, if you look at a couple of recent things from the SEC, they seem to indicate that they don't think public blockchain is useful for anything. And I think it's because of this confusion between, unregulated or what are probably regulated, but were issued unregulated crypto assets that they now call crypto securities versus what we do, which is to issue securities. Right? I fundamentally think that, a public blockchain is a better database if you want to simplify things, because as you said, it's open there. It's very easy to connect to. It's very easy to build building blocks to do stuff. It's very easy to, go and read the information and trust that it's accurate. Mm-hmm. And it hasn't, if it's there that it says that you own this, then it's actually true. So it's 99.99999 infinite uptime, because things like Ethereum, they've never been down, and other databases get corrupted or they have downtime. Some blockchains do as well, but the good ones don't. So I fundamentally believe that if you were to start from scratch to build infrastructure, that would be the database that you would use, right? So, but this needs to be communicated properly, and the fact that there's been blockchains that have fall apart or that have problems or issues like that doesn't help communicate, because obviously regulators are not necessarily sophisticated enough to distinguish between, let's say, Ethereum and something else, right? Mm-hmm. So, and then the other thing is that there's a confusion about when there's a hack. It's not that blockchain has been hacked, but that's the perception, right? Oh, somebody like this DeFi protocol got hacked and people stole $100 million. Well, that's the DeFi guy that was not very good at writing the smart contract and screw up, but that doesn't mean that somebody hacked the blockchain, right? And I think that distinction, which seems obvious for people in the industry like us, but it's actually a lot more subtle for other people, right? They just don't distinguish that. So, and the third thing is that a lot of the issues that we've had in the industry have nothing to do with blockchain. The lenders have nothing to do with blockchain. They were just bad lenders taking unnecessary risks, and they blew up and doing illegal stuff like selling securities without disclosures to retail people, etc. So that has nothing to do with blockchain. They could have done it for other asset class if there was interest to do it, right? So FTX, the same thing, has nothing to do with blockchain. It's just basically a guy committing fraud, right, and stealing customer deposits on a centralized exchange. So, but again, that gives a bad impression to blockchain and the technology. So I think that we're going to have to go through a 12 to 18 months period in which first I hope that nobody does something stupid again and we don't get another drama, because that will not help and will set every time something happens, I believe it sets the industry back for a period of time. Mm-hmm. And hopefully start communicating this message that, blockchain is one thing, it's an infrastructure that is very good. And then a bunch of other things that happen outside that are not because the blockchain doesn't work well. It's just because people are not very competent or people are breaking the law.
Yep. No, absolutely. And so, again, we completely agree. yWhales' thesis is, proper, governance and regulation is what's going to get crypto to that 100 trillion market cap. I don't know where Bitcoin's going to go. I never make a prediction on any single coin, but I do see the global and kind of interplanetary. We're sitting here talking about spaceships and everything else. Blockchain is the future. There's no way around it. There's no other technology that is even in second place to kind of manage ownership in a decentralized and distributed manner. So With all that being said, and we bring this to a close. Carlos, you've come through Web 1, Web 2. You're right there at the cusp of Web 3. You probably thought years ago that it's global adoption is going to happen any minute now. We still have a ways to go. Where's kind of your guiding North Star over the next few years that you're going to continue to drive towards?
I think something I've learned after being in Web3 and as you say, Web2 and Web 1 is that when you touch something that touches money and regulated things, the adoption takes longer, right? And I think that, there's always the people in technology say, oh, well, every new innovation gets adopted faster. Well, for this one, I believe it's not going to be that way. It's going to be slower because it touches things that are regulated, and then that means regulation needs to adapt or be enforced, and that will naturally make adoption slower, right? So I think that that's an important consideration. I still think that this is going to happen is unavoidably. Like if you think about things that get digitized always, there's nothing out there that doesn't eventually get digitized because digitization brings huge advantages for anything. And then the same way that, content got digitized or news or voice or video or many other things will make that, financial services and capital markets will need to be digitized as well, and hopefully on the blockchain, because that seems to be what makes the most sense, right? I still think that we're a while away. I don't think that this is, even though there's all this excitement about real world assets this year, if you look at the stuff that they're doing there is either small or highly questionable whether it's actually legal, which is the other problem. I hope that people don't start like issuing tokens saying that it's a real world asset and issuing a completely non-compliant way, even though some companies are already doing that in DeFi. And then hopefully two things are going to happen, right? Regulation is going to come at some point for sure. And there's two things that are going to happen. One is enforcement, and people don't like that the SEC is enforcing regulation, but in some cases there's no new regulation. I mean, what BlockFi was doing was illegal, period, right? And it has nothing to do with, and they don't require any new regulation to regulate that. I think that enforcement is a way to tell people you have to follow the existing rules. And that, even though you might argue that they've come a posteriori and not a priori, or that they haven't gone after enough people, but, I guess they've done what they've could with the resources they have. The second thing is, adaptation for this new technology that facilitates to do things that from a regulatory perspective, maybe today, are not simple. Like, can you use public blockchain as a way to represent things? How do you settle there in an efficient way? What happens with things like investor accounts and things like that, which are highly restrictive when you suddenly have the ability of democratize access to these products, we change those things, etc. So I think that the next 2 to 3 years, I don't think it's going to be faster. That will happen. And in parallel, I think blockchain still has to solve a lot of adoption issues, right? If you think about how internet took off, it's because eventually internet was transparent, right? Like you were online without knowing you were online. But when I started connecting to internet, I even remember like downloading a TCP/IP stack in my computer because it didn't have a TCP/IP stack to be able to install a model and dial up, right? And then you don't do those things anymore. So I believe that the wallet infrastructure, and I know Coinbase and other companies are doing a lot of good job in trying to bring this infrastructure in a way that wallet creation is transparent, is out there. You don't have to worry about like remember 12, passwords, and it's just integrated in your phone or in your browser, and then suddenly you have access to the underlying blockchain that's through the wallet. I think that will simplify adoption and then bring some sort of on-chain identity as well, right? So if we do it in one way or do it another way, I don't care which one succeeds as far as there's something that ends up happening. But I think that's an important way because when we talk about ownership and ownership of regulated entities, unavoidably there has to be some sort of on-chain ID that attaches that on-chain product into a real-world ID of the investor, right? Because those things are regulated, and as we discussed, you can't just send this token that represents a security to somebody in North Korea or in Afghanistan. So,
yeah, this is fabulous. Again, this is going to be a very long road. The path to $100 trillion is, I think, the correct one to be tracking. Not everyone likes to track Bitcoin, and so do I. It's great, but really the concept of once these assets get on chain, their volatility is so much lower. Their liquidity is so much better. And I think that that's really, hopefully everyone agrees with you. We do, that this is the direction of where to spend the time, energy, and money. And the focus of where blockchain should be is really to fix a lot of the existing problems, not to create new problems that didn't exist in the first place.
Correct. It seems to be a lot of that what has happened in crypto, unfortunately.
Absolutely. yWhales, this is Carlos and Securitize. Carlos, what's the best place for people to reach you or find out more if they want to put some things on chain or buy some things on chain?
Securitize.io, that's our platform. It's open for business. You can register there, and there's some products that are for retail. Even if you're just retail, some other products are for accredited investors or qualified purchasers. Again, depending on the regulatory, situation of the asset. But you can just go there, create a Securitize ID account. Should be a fairly frictionless, process. Fund your account. You can use USDC to fund it. Attach a wallet and go and buy something.
That's amazing. That's amazing. yWhales, go check it out. Securitize.io. This is Carlos. We'll catch you guys next time.
Thank you, Jay.